Good morning, everyone. I see we have some early birds signing in for the webinar. Good morning to Dawn, John, Karen, Kristen, Sue, another Kristen. Very nice to see you guys. Hope you're having a wonderful start to your morning. If you guys would like to tell us where you are tuning in from, what town or city you're hanging out in today, you can use the or question bar to start chatting. I hope everyone's seeing the sunshine like we are. Good morning, Marcus. Thanks for joining us today. So Sarah, what's the weather like in Texas today?
It is a little cloudy this morning, but it's going to be 85 today. So it's starting to get warm.
Wow, that sounds really nice.
It is. It's really nice. And we have a lot just this week. My grass just, exploded. So I had to have the guy come and mow it. So
oh my God.
We are in full force spring here. Flowers blooming, pollen, causing us all to cough and sneeze, but that's part of it, right?
I've got well, it's been very cold, but it's windy enough in Wisconsin that my allergies are in full swing. So I've been sneezing and I'm like, wow, spring is here. That's how I know. My allergies are back.
But no more snow, right?
Hopefully.
Hopefully
I feel like
no
the more
snow.
we think we've gotten through it, the more there's just that slight chance. Good morning, Gail. Good morning, Andrea. Thank you guys for joining us. Kathleen, thanks for hopping in. Meg, Myrna.
I'm sure I've talked with some of you before. I can't see your faces, but it'll be nice to speak with you guys again. And if I haven't met you yet, I'm sure I will. Are we going to do the poll questions?
Yeah, would you like to? How would you like to word them for the beginning?
I guess the ones I have on the slide, we could just have people put in the chat.
Sure, we can do that.
A, B, C, D. That's easier. We'll test your knowledge before we start and after we start. I always like to get a pulse of how people are feeling after we go.
I hope everyone's had their coffee. There'll be pop quizzes.
Yep.
All right, we'll wait about 1 more minute and then we will get started. Thanks again to everyone who hopped in a couple minutes early. Oh, and we've got Tom from our Pewaukee office hopped in as well. Hi, Tom. And good morning to Mandy, Kim, Jennifer, Jenna, Jamie. Hi, guys. Thanks so much for tuning in. All right, it is 9 o'clock, so we are itching to get started. Good morning, everybody. My name is Cassie Hopkins, and I help coordinate the webinars for Hausman Group. I would like to welcome you today to today's webinar, Top 3 Compliance Mistakes That Can Cost You Big, and subtitle, How to Fix Them. And this is presented by Sarah Borders. This webinar, just a couple housekeeping items. It is interactive, which means we'll have a question and answer session at the end. You can type a question in at any time, and Sarah will see it and address it at the end of the presentation. And then after our webinar is over, we're really hoping you can fill out a short survey for us to let us know what you liked, what you'd like to hear us present on in the future, any webinar topics you're interested in learning about. We'd love to hear from you. Oh, I apologize. There's a cat fight in my house.
Love it.
Sorry, everyone. Work from home life. So this webinar will be recorded and will be available on the webinar archive section of our website. Each attendee will receive a follow-up email with a link to the recording and the presentation slides. And now it is my great honor to introduce our speaker, Sarah Borders. Sarah is an industry leader in providing guidance on legislative and regulatory topics such as ERISA, the Affordable Care Act, Section 125, COBRA, HIPAA, Medicare secondary payer and tax advantage accounts such as FSAs, HRAs, HSAs, and DCFSAs. I bet a lot of people on the call here know all about those acronyms. In her previous role as a VP of Benefits Compliance with NFP and Director of Compliance with a regional benefits firm, she has served hundreds of employers' compliance needs, from identification to resolution, written dozens of articles on regulations, and frequently presents on compliance topics. We are so happy to have you here, Sarah. Welcome and thank you.
Thank you, Cassie. Good morning, everyone. This is going to be a good presentation. Hopefully, this will be more of a interactive sort of way to look at your benefit program, see if you're making any of these mistakes. And our goal is not to scare you or make you feel bad or guilty about what you may or may not be doing or your understanding of something. It's really just to help you to make some changes, to make some, in all likelihood, some corrections in the way that you've been doing things in the past, and hopefully to prevent even bigger issues from happening down the road. So I feel that most compliance mistakes that I see are extremely preventable and can be fixed with just the right knowledge and a tweak or some sort of change in your policy implementation. And so we're going to today talk through what are the biggest compliance mistakes out there. We're going to talk about why you should care about compliance. And we did a version of this last year, but some of the issues that I continue to see over and over again, I wanted to highlight these because over the past 12 months, these have become more and more predominant out there as I'm working with Houseman Group employers and their prospects to look at their compliance issues. Also, as a result of some of the questions that I'm getting from some of the advisors, some of the account managers, and also some of the things that employers have been sending to us that they're receiving in the mail from the IRS, from CMS, from the Department of Labor. So these are actual items that have enforcement behind them, and that's why I want to highlight them and make sure that you're aware of these rules and understand how to proceed. So the top 3 compliance mistakes, of course, this list is not exhaustive, but these are the top 3 that I keep seeing over and over again this past year. And how to fix them would be, first of all, your leave of absence policies and a potential for denial of large claims, both under your medical plan or under your life insurance plan. So we'll look at that. Then we're going to talk about the Medicare secondary payer rules and how employers can find a better way to maybe offer employees who are 65 and older and their spouses the opportunity to go on Medicare instead of forcing them off the plan or incentivizing them to take Medicare. Then we'll look at ACA reporting, the forms that we send to the IRS each year if you are an applicable large employer or if you are a small employer that has a level funded plan. You are pretty familiar with these forms, the 1095s, 1094Cs, but there are errors that we continue to see over and over and over again that could trigger an employer mandate penalty letter. And some of you may have seen these before. They're quite common. So we don't want you to get one of those in the mail. So we want you to know what to do to prevent them. Then as a bonus, we'll talk about the Form 5500 filings because we continue to see confusion around those areas. And then we'll have time for some Q&A. So if you will just type into the chat. We want to get started with our fun poll question. Don't worry, this isn't going to, we won't shame anybody. This is a safe zone, but we wanted to see how confident you are about meeting your company's health plan and employee benefit obligations. So if you could type into the chat, A, we're pretty confident overall. We're on top of it. B, we've got some work to do. C, I'm feeling nervous and I may need some help and you already know it. Or D, I know we are lost and we're not doing anything in a compliant manner. So if you can just type that into the chat, we'd just like to get a gauge of where you're at today. Okay, I'm seeing a lot of A's and B's. Just a few more seconds to get everyone A/B. I don't see any D's yet. Maybe that's because we've worked together before and you feel more confident after that, hopefully. Okay.
Looks like it's almost 50%. I would say we've got a lot of A's and a lot of B's.
That's great. We'll see how you feel after we're done today. We'll take another poll question. So thank you for having that little fun poll. Okay, so let's look at why should you care about compliance at all? And there are many reasons. The first is very obvious: to avoid fines, penalties, and lawsuits. That's kind of the main reason that we want to go along with the law, do what the departments tell us to do, manage our risk, to avoid getting a fine, a penalty, or engaging in some sort of lawsuit from a disgruntled employee or their spouse or some kind of other entity that is interested in suing you or your health plan. But we also have a lot of other effects on mismanagement of compliance obligations. One of those that is very costly is the time that it takes to correct errors. So I think this goes unnoticed because it's just kind of been the frenzy of the day. But when there's an error or some sort of mistake, maybe let's say a COBRA notice wasn't sent to 20 or more employees a year ago, you've got to spend hours researching who should get one, what went wrong, who's going to send it, how are you going to send it. You had to find out the correct answer in the first place from the right person. And so there can be just hours spent in correcting these errors that may not have clear guidance as to how to correct it if the failure is has gone on for a long time. And so we want to make sure that these errors are prevented before they become just, fires that you have to put out and spend a lot of time on. It also protects your business. So we think about compliance as what I have to do, kind of the various laws that are put out there are usually designed to protect the employee, but also we have to remember that complying with a law like ERISA or Section 125 or even the ACA actually protects your business from paying claims that you don't actually have to pay. It allows you to write a plan document and go through the areas of eligibility that you want to define. So it protects you and your business when you have things that you're doing properly. A great example of this would be COBRA. So if you are managing COBRA correctly, sending out those notices, sending out those initial notices timely, sending them out by mail, that's the preferred method. That will protect you in the event of any sort of informal complaint made by employees or even a lawsuit that's brought by an employee, because if you can show and demonstrate that you complied with the law as it says, then that usually settles the matter and it doesn't go any further. So it really protects your business. It protects your employees. So you want to have your employees receive the benefits that are promised to them. If there's a question about a benefit or some sort of exclusion, we want to be really clear on what it is so it protects them and what they understand. It covers their medical conditions, but it also protects you from having to engage in some sort of adverse benefit determination or some sort of denial that you have to engage with and cover something that maybe you didn't want to cover in the first place and didn't have to. Also provides a framework just to avoid abuse. Abuse can come in many forms. It can come in adding dependents that are not eligible for the plan. It can come in, not providing information up front. It can come in the, not giving employees benefits that are promised to them. There are many aspects of abuse that can be prevented by providing this framework that kind of gives you guardrails to follow. Everybody kind of knows where their place is. And so these are the reasons to care about compliance. The next reason, as I mentioned before in other webinars, is your fiduciary duty. And this is really important because I don't think employers really understand that they have this heightened level of an obligation as a fiduciary. So a fiduciary is really any person or entity who makes decisions regarding the management of the plan or the plan assets. It's not purely an administrative function, like maybe you're involved in more of the administrative and not so much the decision-making functions, but a fiduciary, somebody who has decision-making authority over the function of the plan, over the management of the plan, especially if you are self-funded, then you are a fiduciary. And so this means that you could be personally liable for failures to comply with the various laws that pertain to operating a benefits plan. When you decide to operate a benefits plan, you do have certain obligations. Now, agencies like Hausman Group do a fantastic job of assisting you with what you are supposed to know, but they can't totally take this off your plate. Compliance just definitely cannot be totally and completely outsourced. It's kind of, I liken it to paying taxes, just personal income taxes. I can hire a CPA and they do the heavy lifting and they are taking on some of that liability because I'm placing my trust with them and they do have an obligation. But ultimately, as the taxpayer, they're not going to send my CPA a tax bill that if I, submitted incorrect tax filings, they're going to send it to me. And I may have some protections again with that CPA, but ultimately it's on me. And that is the way that you need to think about your fiduciary liability. So fiduciaries, they have certain types of obligations put on them, and I've listed them here. You have to act in a participant's and beneficiary's best interest, which is kind of counterintuitive because we think of the employer's best interest, but it's really the employee's best interest. That doesn't mean that you have to cover everything for them and let them just run all over you. It just means that you have to pay the benefits as described and the benefits that are required by law. Only use any plan assets to pay benefits or reasonable plan administrative expenses. So this relates to how you spend the funds that are used to pay claims, to pay those administrative. When you pay your CPAs, there's a fee, for them to administer your claims. There's many fees built in. And so all of those are in the best interest of the plan. What we sometimes might see is using those funds to pay for other expenses that are not even a part of the benefits plan. Like maybe an employer uses their claims fund to pay some sort of, payroll, or maybe they use it to pay some sort of bill, something like that. That's just a no-no in the fiduciary world. We also have to act with the same care, skill, prudence, and diligence of a prudent person acting in a similar situation who is familiar with such matters. So this is the Prudent Expert Test, and essentially it's a common sense test for somebody who has knowledge of these things, somebody who should be knowledgeable in this area, who's been placed with these responsibilities. There's a test of kind of common sense. You should have known this because of your role and your responsibilities. Minimizing risk of large losses by diversifying plan assets. This really applies more to retirement plans, but it can apply like if you allow people to invest their HSAs. And then following the plan documents, the plan terms. So we always want to make sure that employers have a plan document, they know what it says, and that they are following it, because ultimately if there is an investigation or some sort of litigation that's brought, the court or the investigator will almost immediately want to see the plan document and say, what does it say? And if you don't even know if you have one, then that can be a problem. Again, your advisor, we can help you get one of these in place, but it's ultimately your responsibility to make sure that it's maintained, that it's sent out, that it's up to date, that it's amended. And we will do all we can to remind you and assist you and do some of the heavy lifting for you. So I just want to mention this because I think there can be sort of a misconception about an employer's role in all of this, that their broker just does everything. And while that's somewhat true, where we help a lot, again, going back to the CPA analogy, it doesn't totally absolve me of my responsibilities whatsoever. So let's get into the number the third most common compliance mistake that I see that could wind up being a big, hairy fire that you need to put out, if that's a word. So first of all, the leave of absence policies, the SPD, and the other enrollment materials like an enrollment guide or maybe a handbook or some sort of policy that you provide to your employees, they're not matching. They don't say the same thing. So for example, the benefits eligibility that's listed in the SPD, the summary plan description, and also in the carrier's booklets or the carrier certificates of coverage. So for example, if you have quartz for your medical plan, maybe you're fully insured, or maybe you're self-insured and you have Allied as a TPA, those contracts, those booklets that they provide you are going to spell out in all likelihood some sort of default language about when a person becomes eligible for the plan, but more importantly, when they are no longer eligible for the plan. This is where problems happen over and over again, is when your handbook, your leave of absence policy, whether it's in writing or it's just something you do kind of informally, it can be in conflict with the SPD and what the carrier contracts actually say. And what could happen, especially if you're self-funded and you rely on stop loss to pay claims over and above a certain amount, then the stop loss carrier could ask to see your leave of absence policy and your SPD, and they are not saying the same thing, and they could deny that claim. And that could mean that the employer has to pay the full amount of that claim. This could also happen with fully insured plan, where the fully insured carrier does not recognize your leave of absence policy under their contract, and they may deny that claim as well, which could end up in litigation or you having to self-insure that claim, even if you're fully insured. So again, I'm not trying to be scary or say things that aren't true, but I feel like I get on calls probably once a week regarding this issue. So let me give you an example. The carrier's contract, meaning Quartz, Delta Dental, Wisconsin, but mostly the medical insurance and even the life insurance, these potential large claims that can come about as a result of a large medical claim or a life insurance claim. These are the areas we really want to focus on. So for example, let's say the carrier insurance company's contract or the SPD or a wrap document may state that eligibility is an employee who is regularly scheduled to work 30 hours or more per week, or who is out on FMLA leave, which is generally only for 12 weeks out of a 12-month period for FMLA. Now, under FMLA, you must continue benefits eligibility while someone is on a qualified FMLA leave. That is the only type of federal protection for benefits continuation, other than COBRA, which would be post employment or even a reduction in hours. We'll talk about that in just a moment. But then in contrast to this carrier eligibility definition, this is a common one we see, the handbook or a leave policy may promise, for example, employees on a disability leave of absence will retain their ongoing seniority and benefits. So we're talking about seniority, but we're also promising that their benefits will continue. Health and life insurance will be provided for a period of 6 months. So right there, it promises something that the contract does not allow for. So this is the kind of thing that we want to prevent from happening, because not only is it confusing for you because you don't know when to terminate benefits, but it's confusing for the employee because they don't really know what to expect either. So instead, we want to really shore this up. And let me go through these bullets in just a moment, because they're very important as well. Any benefits that are continued while not actively at work must be allowed under the eligibility provisions of the plan document or the stop loss carrier's contract. I mentioned this previously, including your ancillary benefits. But again, dental, vision, those are not quite as severe because their claims are not very large. And usually the carriers are pretty open with allowing for a longer eligibility period. But where we see those problems again is with life and medical, because the claims can be hundreds of thousands of dollars. That's why. Under ERISA, remember, the plan sponsor has a fiduciary duty to follow the terms of the plan document and the SPD. So if you don't know what it says, how can you follow it? It's important to review it. Otherwise, if someone incurs a large expensive claims or dies while out on a non-FMLA leave, and their policy or SPD says this person is ineligible, the carrier could deny it and the employer could wind up self-insuring the claim. Worst case scenario, it could cost hundreds of thousands of dollars and sometimes millions of dollars. So what are you supposed to do then? Here's some tips to kind of avoid this mistake. You'll want to review your handbook. What does it say? Maybe it says something that you're not doing in practice. A lot of times we'll meet with employers and they'll say, oh, that's old, we're redoing our handbook now. We don't actually follow that. Or maybe you have something more generous than's listed in the handbook or leave of absence policy, and it's kind of just some as needed, as provided, we give extra leave to employees who might need it. We want to avoid that because you want to be consistent across the board, not only for employment law purposes, but again, to delineate when does eligibility end? When do you take this person off of the coverage? In other words, when do you offer COBRA? And so the general rule of thumb is to allow it, you must allow it for the duration of a qualified FMLA leave. And then if you want to allow any maybe 30 or 60-day employer-approved leave past FMLA, or maybe even for those who are not qualified for FMLA, you'll just need to have it in your leave of absence policies, but make sure that your carrier certificate of coverage or your self-insured SPD actually provides for that. It actually has language that allows for a more generous continuation of benefits. And then when they're no longer eligible, you would terminate their coverage, maybe not necessarily their employment, but their coverage for reduction in hours, and they lost eligibility, and that would be a COBRA qualifying event. You would terminate coverage and offer COBRA at that point. Keep in mind that as an employer, you can pay for COBRA premiums, but the difference between an active employee and somebody on COBRA, there's a lot of differences, but the claims still will get paid. And so you can decide and tell this employee, yes, we will pay your COBRA premiums for a duration of 3 months or 6 months, however long you decide is fair, or how long you want to help them. But again, we want to be consistent across the board and not just give it to some people but not to others. So we want to be careful with that. So reviewing your handbook and your leave policy is very important. Compare them to what the WRAP, SPD, and the carrier contracts actually state. And where there's a conflict, you'll want to revise your handbook, amend your plan documents, which might trigger a summary of material modifications. And then you'll need to check, if you're self-funded, you'll need to check with the stop-loss carrier, or even if you're fully insured, you'll need to check with your fully insured carrier to provide a more generous benefit continuation policy while someone's out on non-FMLA leave. Benefits continuation is not always required when someone is on disability, short or long-term disability. That's kind of a misnomer. Workers' compensation or some sort of ADA accommodation. So they're usually those would run concurrently with FMLA. So for example, somebody could be on a short-term disability policy. They could be on claim, but they're also out for their own serious medical conditions. So the 12 weeks of FMLA protection could run concurrently with their disability payments under the group disability plan. So just disability by itself, perhaps they're out on disability that isn't a qualified FMLA leave, usually because they haven't worked there long enough, that would not automatically give them the right to benefits continuation. So again, you may have to stop coverage and offer COBRA, and then if they return, you would just put them back on the plan. Workers' compensation or ADA accommodations where leave is an accommodation, that does not necessarily mean that you have to continue benefits eligibility. So if you have a situation like this where you've got an employee who's kind of stuck out there and you're not sure when to terminate benefits, please reach out to us and we can look at the situation and try to help you navigate what to do next before it gets really serious and 6 months has gone by and you're not really sure what to do next. So this is very common. Please address it if you haven't already, and take those proactive steps to mitigate this area of exposure. Okay, so the next area that I see over and over again, and this is becoming more and more common. And I think that's because there is a sense of wanting to give Medicare eligible employees an opportunity to take Medicare, because Medicare is cheaper than group insurance can be. It often pays better than group insurance does. But we want to be very, very careful with offering or incentivizing or outright excluding individuals to drop off of the group health plan to take Medicare. And that is because of these wonderful rules called the Medicare Secondary or MSP rules. These rules, my last bullet here, we'll just say up front, the purpose of the MSP rules is not to help the individuals pay less. It could care less about the individual's financial situation. The purpose of the MSP rules is to govern when a group health plan is the one that has to pay primary. They have to pay claims first, and then Medicare might pay whatever that plan didn't pay secondary. And that's mostly with the group plan paying primary, so Medicare can pay less. Those are the point of the MSP rules, is so that Medicare can pay less, group health plans pay more. That's all it is. So with that in mind, then you can understand, okay, now I see why they don't allow us to take people off of the plan and try to get them on Medicare, because they're running up large claims. This rule prohibits, I'm going backwards here, prohibits employers from financially incentivizing Medicare eligible employees and their spouses to drop the group plan to take Medicare, including allowing or providing to pay for a Medicare supplement. This rule applies to employers with 20 or more total employees. And so if you are larger than 20 or more total employees, not employees on the plan, but total employees, then you would be subject to the MSP rules, whether you know it or not. So for some of you, this is not a practice that you're engaging in. Maybe some of you currently are. Maybe some of you have talked about this or have thought about it before and haven't really spoken with a Houseman Group advisor yet about this. But the point is that we don't want to have any sort of practice like this. And so there's some other things that you might consider doing, but we want to be clear that an individual can voluntarily drop your group health plan insurance to take Medicare. That's allowed, but we don't want to hold meetings or send out documentation or approach them and say, hey, if you drop Medicare, we'll give you $300, or if you drop the group plan and take Medicare, we'll give you $300 a month to help you pay for that. How does that sound? Oh, it's great for everybody. The group plan's less, the claims are less, they're paying less. It sounds great, but again, these rules are wide. We cannot allow that kind of practice. Now, if you are smaller than 20, if you have 19 or less total employees, then you can incentivize people to take Medicare. But the reason for that is because the group health plan would pay secondary anyways. Medicare would pay first, even if they were enrolled on the group health plan coverage. So it's kind of not as impactful for a small or very small group plan. But for those who are over 20, this is a rule that you need to consider. There are significant penalties for failure to comply with the MSP rules. And I decided to add this to today's discussion because I kept hearing about it, and I actually have seen over the last few months, I believe 2 different letters from CMS that were outlining a specific claim. They listed the employee, the member on the plan, and they listed out the claims, the amount of the claims, and it basically said, in a nutshell, that CMS, their department that looks at these things, believes that the group health plan should have paid primary because this person was enrolled in the group health plan and also in Medicare. So that would be pretty alarming for an employer to see that, and it did assess penalties for failure to notify CMS that this person, because these MSP rules applied. So there could be a violation of the prohibition on financial incentives That could lead to civil penalties of up to $5,000 per violation. So this would be agreeing to pay Medicare premiums, giving them a stipend, giving them money to pay for Medicare supplements, allowing a group Medicare supplement plan. None of those should be in practice for employers with 20 or more total employees. Offering incentives to Medicare eligible individuals not to enroll in a plan that would otherwise be primary. That penalty just was increased back in March to $10,360. Now, a failure of a responsible reporting entity, or RRE, for example, a carrier or your TPA that you're hiring to administer claims, to provide information identifying situations where the group health plan should be paying primary, could be up to $1,325 per day. So that can get very expensive if that's been going on for months or years. I've also included here a chart to kind of show you who play this. These are the MSP ordering rules, and they kind of dictate when the group health plan has to pay the claim first, and then when Medicare pays anything that's left over. And so you can see here that age-based Medicare applies when the employer is pretty small, that 20 or more employee mark. It applies to Medicare eligibility for those who are disabled. So not all Medicare is based on just being age 65. Some who are disabled can receive Medicare, and that would apply when the employer has 100 or more employees. COBRA participants who are enrolled in Medicare, however, Medicare should pay primary to the group health plan in those instances. So again, that is why it's really important to terminate coverage according to eligibility, because then they're on COBRA and your health plan is not paying first. Medicare would be. And when the participant has end-stage renal disease, ESRD, there are special ordering rules that relate to when the group health plan pays primary and secondary. So the group health plan has to pay primary for the first 30 months of their Medicare eligibility, and then Medicare pays after the 30th month of Medicare eligibility. So there are special rules depending on what type of Medicare the individual is eligible for. But the main one that we really want to focus on is the 65 or older Medicare, including the spouse. So what are some next steps to avoid compliance mistakes? So review your total employee count to determine if these rules apply to you and your organization. You will probably know that right away whether they would or not, but it is a look back period. You would look back the prior year to see if this applies. And then if it does, we want to avoid any sort of incentivizing of Medicare premium payments or outright exclusions for Medicare age persons, including the spouse. Provide your current employees who are age 65 or older with the same benefits under the same conditions, meaning the same eligibility conditions as are offered to those who are under age 65. If you are subject to MSP rules, do not exclude or incentivize Medicare eligible individuals to drop your plan to take Medicare. Instead, you could consider offering a cash in lieu plan, or a cash out, or an opt out. This would allow you to not just provide a cash incentive to just Medicare individuals, it would allow you to provide an incentive to not take your group health plan for all those who can provide proof of other coverage. So this would include those who have a spouse's plan. It would include Medicare here. It would include a parent's plan, or maybe they have access to another employer's plan. So you could provide this cash in lieu benefit for individuals to go ahead and take that coverage and not take your plan, and you just give them $100 a month, $200 a month in taxable cash. Now, it does not include taking individual coverage from the exchange or a Medicare, or excuse me, Medishare program, or Medicare share, Medishare sharing ministry, health sharing ministry. So if you are looking for a way to incentivize people not to necessarily take your plan in a compliant manner, you'll want to look at a cash in lieu option instead of just having like a Medicare classification. That's not permissible. Okay, so Cassie, I'm not able to see any questions, so let me know if there's any questions that are coming in.
So far, no questions.
No questions. Okay, we'll have time for questions at the end. All right, and so the number one area that can cost you big, that's easy to fix, is the ACA reporting errors. So what do I mean by ACA reporting? I mean the 1095Cs, the 1094Cs, which are going to relate to those who are considered applicable large employers, ALEs for short. So it is the ACA reporting is the ALE's responsibility. It is not the carrier's responsibility. It is not your payroll provider's responsibility. It is not your broker's responsibility. It is the individual entity's responsibility, just like you would for W-2s. In fact, they are sent out around the same time as W-2s, although a little bit later. Remember that applicable large employers must distribute these 1095Cs to full-time employees by March 2nd. So there was a delay, a permanent delay put in place. So 30 days past January 31st, which this year fell on March 2nd. So that means you must also file the 1094C, which is the transmittal cover sheet, along with the 1095Cs to the IRS. So you send them out to individuals just like W-2s, but you also have to file them with the IRS. Those would be due by the end of March for electronic filings, or by paper would be due by the end of February. So the IRS forms 1095C and 1094C, they tell the IRS if you're complying with the employer mandate. And if you are an applicable large employer, you have to comply with the employer mandate, or you could be assessed a penalty, penalty A or penalty B. Coding errors on these forms, and I'm going to show you what these forms look like and where I'm kind of wanting you to check. Coding errors and information mistakes are the main cause of these letters called ESRP payment letters. And I have an example of one of those as well. Maybe some of you have seen these. Maybe some of you are dealing with this right now. But these are the main cause of these penalty letters, and they are completely and totally preventable with just, you know, maybe 30 extra minutes of oversight. Taking the time to look over these forms and question things that look incorrect. What triggers a penalty letter? What causes one of these penalty letters to come? Is it just coding errors? No. They are triggered when one employee receives a premium tax credit on healthcare.gov or one of the other exchanges, a state exchange, for at least 1 month. And the forms don't indicate that the correct coverage was actually offered to that person. So why were they allowed to get a premium tax credit if they weren't actually eligible, and your forms aren't telling them that you're relying on a safe harbor, and your forms are telling the IRS that we didn't offer coverage to 95% of our employees? Those are where the coding errors fall. So not every employer is going to receive an ESRP payment letter. It only happens when just one employee goes to the exchange and receives a premium tax credit for at least 1 month during the year. The problem with these penalty letters is that they can be from 2 to 3 years in the past. So right now we are seeing a lot of penalty letters from 2019. 2019 was before COVID. So much has changed since then. We've had turnover in HR departments, turnover in payroll departments. We've had changes in vendors since then. Likely you've had a change in your payroll vendors, at least some sort of slight change in that payroll vendor. Maybe you don't have any idea where your predecessor kept all of those waiver forms. So that's the problem with having to deal with these letters, is they are so far in the past that it's hard to dig up the information to be able to present to the IRS why you don't owe it in the first place. So this is why we just keep saying over and over again, please, please, please review your forms before you submit them to the IRS. So this is an example of a 1095C. The 1095C is going to each full-time eligible employee. Now you can see here that I have 2 red arrows that are pointing to line 14 and line 16. In line 14, we would place the 1 series codes. So for example, if you offer coverage that meets minimum value, it's affordable, it's a major medical plan, a Blue Cross, Quartz, Dean Health plan, a standard major medical plan, you're going to, in all likelihood, in one of these boxes, put code 1E or 1A. Then you would put in line 15 the amount of the lowest cost plan for single coverage that the employee has to pay. Line 16, however, is where we see a lot of problems. And this is because sometimes the payroll vendors or the ACA vendors will leave these blank when someone doesn't actually take the coverage. So if they waive the coverage, that should not be blank. If they do take it, it will say 2C. That's kind of the way you tell the IRS, yeah, they took the coverage. If they didn't take it, and many employees will waive coverage, and you don't really know why they're waiving coverage, they just don't want it for whatever reason. And if that is left blank or there's a miscode in line 16, then you're basically telling the IRS that the coverage you offered wasn't affordable or it didn't meet minimum value, and they might assess you a penalty B, which is not the biggest penalty, but it can add up, especially if you have 4, 5, 6 employees that receive premium tax credits in that year. And all of these were left blank, or they're just mismatched, or they're not the correct codes. So make sure that if you are going to rely on one of those affordability safe harbors, federal poverty level, rate of pay, or W-2, and you should know that by now which one you're using. And if you don't, we can help you. But you would need to indicate that when somebody waives the coverage, you would need to use code 2F, 2G, or 2H. So again, not to get too technical with you, but a lot of you are used to reviewing these forms by now. This will go a long way to just spot check them, look at somebody that you know waived coverage, look at somebody that you know left employment during the middle of the year, and just make sure that those codes are correct. On the instructions, the IRS instructions, it tells you exactly what each code means. So it's not the hardest thing to look at them and kind of see, yes, this makes sense. This is what we can see the history of this employee in this 12-month period. The other coding error that I see quite often, and I've actually marked one here to show you what can easily cause $50,000, $100,000, $500,000 in penalties under the penalty A. And the issue is with this section of the 1094C. So the 1094C is the cover sheet, the transmittal form that is sent to the IRS with the employer information on it. So you'll want to take a moment to look at the second page under Part 3, which I've included here, and make sure that all of those boxes under this column, this first column where it says yes, no, you want all those boxes to say yes. If you have boxes that are marked no and somebody received a premium tax credit for February, March, or April in this example, then you're telling the IRS that you did not offer minimum essential coverage to at least 95% of your employees. And in the most instances you have and did, but for whatever reason this got marked in error as no. And that will apply a penalty of around $2,500 per employee minus the first 30. So that could get really expensive, and that's why you're seeing some of these very large penalty letters that you have to kind of go and say, no, we offered the coverage and here's our proof, this is an error, it was caused by our payroll vendor. So just make sure that these are marked yes, and skip hours of work 2, 3 years down the road. Very easy fix. Okay, here's a copy of a penalty letter so that you can see what it looks like. So this is just a copy of where I go to look immediately when I see one of these ESRP penalty letters. So they're pretty long. They're usually about 10 pages, and they explain what the rule is, why you violated it. So it kind of gives all this background information, a lot of text. It's hard to read through. But the area I go through right away is this table, which is listed on the 3rd or 4th page of the letter. And you can see here that each month is listed out, and this is referring back to how the employer marked this. So I always want to see, okay, for 2019, since this says 2019, how did you mark your 1094C? Because it says here on November and December, you can see there that it says no, no. Under that very first column, it says yes, 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 yes for all months, and it says no and no. And so the IRS believes that this employer did not offer minimum essential coverage to at least 95% of their employees for November and December because this employer told them that they didn't. So you can see how that 149 employee count minus 30 ended up multiplying that penalty times that number of employees, and that is why this employer received a $52,000 penalty letter right around the time of Christmas. Not a great thing to get for to go on Christmas break with. So what had happened with this employer was they had a payroll vendor changeover during the year. They didn't really know to look at their ACA forms, and they just sent these letters or sent these forms off to the employer with a lot of errors. And 5 or 6 employees actually received a premium tax credit when we were looking into it. But that is actually, it was one employee, excuse me, one employee that you can see here count in D and E, that there was one person that received a premium tax credit that caused all of these issues. So please do not let this be you. Please take steps to mitigate these errors. And here are just some things for you to look at. First, most obvious, review your 1095Cs and your 1094C before submitting to the IRS. File on time each year. Don't file late because penalties will accrue for late filings. There's no more good faith effort relief in 2021 and going forward. Make any corrections to your forms when the IRS pings them back and says that there are errors on this form. Make sure that you take steps to correct those errors, get the correct information, and submit corrections with errors. Collect signed waiver forms from your full-time employees and store those copies, because that is going to be your defense against any sort of penalty letter, because it shows that you offered the coverage and they waived it. Look at which safe harbor you're using under line 16. Are you using 2F, 2G, or 2H? And make sure that it actually says that when the employee waives the coverage. Lines 14 and 16 should have codes for all months unless you are using the qualifying offer method, which is code 1A on line 14. Review your 1095C, or excuse me, 1094C Part 3 to ensure all months are marked yes and there are no months marked no. And where no offer of coverage is made, and this could be because the employee hasn't worked there for those months, maybe they're part-time for part of those months, or they're in a waiting period, you would use these codes. Don't leave it blank. You would use, for example, if there's no offer of coverage made because they were not an employee yet, 1H, 2A, 1H, 2B, or 1H, 2B. Again, that is telling the IRS that you're complying with the employer mandate and kind of what is going on with that employee. It's very important. Okay, so as a bonus, I wanted to mention the Form 5500 filings for health and welfare. So remember that ERISA plans, and most employers are subject to ERISA. The only exclusions from ERISA would be governmental plans like a school, a county, municipality. Those would be exempt from ERISA, or an actual church, a church plan, not affiliated with the church necessarily, but a church plan. Those types of employers are exempt from ERISA, but all other employers, even if you have 5 lives, are subject to ERISA. Now, ERISA plans must file the Form 5500 annually for the health and welfare benefits by the last day of the 7th month following the end of your plan year, with an extension allowed. Small employers, there is an exemption from filing Form 5500. There's not an exemption from ERISA and all its requirements, including the fiduciary duties. But if you are less than 100 participants on the first day of the plan year, including for your employer-provided life insurance, then you are exempt from having to file the Form 5500. However, if you are larger than 100, maybe your life insurance, your employer-paid life insurance has 101 employees on it as of the first day of your plan year, then you will need to file the Form 5500 Maybe you're doing it for retirement, but you also need to be doing it for health and welfare. There is no statute of limitations for this, so if there were years where this hasn't been done, there may need to be a delinquent filer program that can kind of catch you up and prevent penalties from being assessed, because they are significant. Failure to file a Form 5500 is $2,400 per day for failure to file a required Form 5500. That will be for penalties assessed after January 15th, 2022. So these penalties increase each year. The DOL can easily cross-reference your retirement plan numbers with the lack of a health and welfare filing. So keep in mind that this is public information. We can easily see if you can file it or not, or should be filing. And that usually is indicated by, I'm looking at a retirement plan filing with 500 lives, but I don't see anything for health and welfare under the DOL's free ERISA tool. Remember, the TPA or carrier does not file on your behalf. Sometimes they might offer to do it on your behalf, but usually I see CPAs doing it or specific 5500 vendors doing it. So don't be under the impression that, oh, our TPA is doing that. This is an employer responsibility that you need to make sure is happening. It also requires distribution of the summary annual report, or a SAR, within 2 months of filing the 5500. So maybe you're filing it, but you're not giving out the SAR. That would need to be provided within 2 months of filing. So I've included here a copy of a 5500 just to show you what it looks like for health and welfare. And this is one I just pulled off of the ERISA website. And this may look somewhat familiar to you, but this is essentially what needs to be filed with the Department of Labor each year. Again, if your plan has 100 or more plan participants as of the first day of the plan year. If you have a wrap document in place, then you would file, even if just one of your plans, one of your component plans has 100, you would file for all of the component plans because they're all wrapped together in an ERISA wrap plan document. So make sure this is happening. If it's not, please reach out to us ASAP so we can get this corrected. So next steps to avoid compliance mistakes with this very large gap, if it's happening, for Form 5500. Review your participant counts as of the first day of the plan year, paying special attention to employer-paid group term life, where every full-time employee is enrolled. If filings haven't been done for past years, consider filing as soon as possible under the Delinquent Filer Voluntary Compliance Program. There is no statute of limitations here. So the Delinquent Filer Program will basically cap your liability off, depending on how many years are delinquent. It will cap it off at a total of $4,000, not per day, but just total $4,000. Which is significantly less than if you get caught and having to pay $2,400 per day for how many years you haven't filed. So don't let that be you. If you are not doing this or did not know that you had to do this, we want to make sure that you, first of all, have to do it. And then if so, Delinquent Filer is available to kind of catch up and cap off any liability lurking. Consider putting a wrap document into place to file one single 5500 instead of multiple 5500s, for one for life and disability, one for medical, one for dental. It's just easier to put a wrap document in place to file one singular filing. Keep your records for up to 8 years in case of an investigation or a request from an employee or request from a regulator. You'll want to have those documents maintained for up to 8 years, and that it's put in a central location so that your anybody that takes over your position in the future will know where to locate those documents easily. And then send out your summary annual reports within 2 months of filing the Form 5500. This is the same for retirement, but it isn't retirement. It's just similar to it. So make sure that that is being done and that your SARs are going out. So I wanted to just take this poll question again and get your polls after we've discussed some of these issues to see how you're feeling now. Do you still feel pretty good about these things, or are there some areas that you may need to address very quickly? So go ahead and type A, B, C, or D into the poll, and we'll see kind of where we're at today.
Yeah, just a reminder that you put it in the question feature, and it looks like we've got a lot of B's.
Maybe more
Yeah,
B's
a couple
than we
A's
had
are
at
coming
first.
through.
Great.
Luckily, no C's or D's. That's always good to see.
And maybe that's because the people that are interested in compliance are attending today. Maybe we'll say that.
Exactly.
Okay, well, maybe there's a few of you that thought, okay, there are some things we need to address, but we're still pretty good. So I do see a question here that I'll go ahead and answer since it relates to what we just talked about. Should every company have a wrap document no matter the size? The answer is yes, because ERISA applies to companies, again, unless you're a government or a church plan or an Indian tribal plan. It applies to even very small employers, and therefore you would need to be disclosing the required ERISA language. And won't necessarily relate to 5,500 filings because you may be too small to have to file them, but you still would need to have an ERISA wrap document even if you're not having to file Form 5500. So no matter the size, that's true, that's correct. If you need one, if you need help with one, we will provide one with you or for you. Okay.
With that in mind, does anyone else have any more questions for Sarah?
Okay, question came. If you discover an error was made on a 1095-C form, example, coverage was reported for an employee and was actually waived, what should we do? Great question. So you can submit a corrected form to the IRS, which I would highly recommend doing that. And you can submit a corrected form. There's a box to submit correct. If you work with a payroll vendor or some sort of ACA reporting vendor, then they should have steps to submit a corrected form. And you will also need to send out a corrected form to that employee to make sure that they received the corrected form. They probably won't do anything with it, but you've met your obligation to send it out and to correct the form. If it's been a very long time, like maybe that was last year or years past, it may not be advisable to send a corrected form at this time. But if we're talking about the 2021 tax year, then you're still within the time frame to submit corrected forms. Good question. So if you have any more questions, type them into the chat, but I just want to share some resources with you. So we have a lot of resources to assist you. We have our compliance calendar that is available to any groups depending on when your plan renews. We have our compliance checkup that some of you may have gone through with us available. This is a way for us to really get on the phone and dig into some of these issues, get your questions answered, and see where any gaps may be lying. So if you're interested in going through a compliance checkup, please let us know. And we have many other resources. We send out alerts. Please pay attention to those alerts. We will have normal webinars. We will be talking next about the PCORI fees and implications with PCORI fees. And if you're not really wanting to do a compliance checkup with us on the phone, you can certainly take your free online self-assessment using this link, which is provided in the slides. So this will take you to a link and you'll go through the questions by yourself and it will produce a score and a report. But again, you have the option of doing it with us on the phone if it makes sense for you to take the time to do that. And here, I believe, are the SHRM credits and HRCI credits for you if you want to have those for your license. Any other questions before we end today's call? I don't see any others coming in, so I'll hand it back over to you, Cassie.
Thanks, Sarah. Yes, and just a reminder to everyone that you will get a copy of the presentation slides. So those resources will be emailed to you along with the SHRM and HRCI credits. Thank you guys so much for joining us for this webinar. We really appreciate your time and your passion for learning about compliance. Please remember to fill out that short survey. We love hearing from you guys, and your feedback is very important to us. And we hope you can join us in our upcoming webinars. Keep an eye out for our upcoming events and webinars. We are going to be doing a lot more as we gear into the spring and summer. So if you have any ideas or topics you'd like us to present on, just feel free to put those in the survey. And with that, have a great morning, everyone. And thank you again, Sarah, for joining us and presenting.
Thank you all. Have a great day.